Hi, I'm Daniel Brereton, Director of Investor Relations at EquityMultiple, and I'm here to break down an oft-heard term in commercial real estate, preferred equity. Most commercial real estate projects require multiple layers of financing in order to achieve the business plan. When bundled together, we refer to these layers collectively as a capital stack. Within the capital stack, each layer of financing comes with its own balance of potential risk and reward for the investors that are contributing capital. If you picture these layers of capital in, well, a stack, preferred equity sits squarely in the middle. Below it is a layer of capital known simply as debt or senior debt, offering modest potential returns to investors, but safeguarded by the value of existing property and structures. Above it is the equity layer, sometimes also called the common equity layer, generally offering higher potential returns and, with it, a higher degree of risk. In between equity and debt sits preferred equity, the subject of this video. Preferred equity is so named because investors in this layer of capital receive preferential treatment to common equity investors. They often receive payments on a monthly or quarterly basis over the course of the investment, and when the investment plan is completed, they'll often receive the principal they invested along with additional earnings before the common equity holders. But the security of this preferred position comes at the cost of potential earnings. The share of profits from a successfully executed business plan are capped for preferred equity investors. It's also important to understand why a sponsor or developer would seek out preferred equity investors. This middle slice of the capital stack is often referred to as bridge lending, bridging a funding gap between senior debt and common equity. Sponsors in the middle markets often have to find multiple sources of capital. Depending on how they source that capital, they often have a gap, and that gap is filled by mezzanine debt or preferred equity. It's more about filling it out and providing each investor a various risk-reward structure that fits for them. At EquityMultiple, we believe that investing in preferred equity can be a good option for investors who are hoping to earn passive income in the form of monthly or quarterly distributions, or for anyone looking for diversification across the capital stack. On our platform, investors can choose offerings with a diversity of hold periods, distribution schedules, and risk-return profiles in order to achieve a diversified commercial real estate portfolio. Happy investing.